Can you see a widening of a spread at the bottom edge here? Yes or no? And the problem is, if you've got a spread that's widening at a bottom edge, the trade is going to be where? The bottom edge. Which means it's going to be a weak-handed fade buy trade. Can you see the spread widening at a higher price following the bottom edge? Well, there it is there, right? It goes up. It then drops down, and that becomes what we know as a spring trade at a higher price, right? So when we see that, what we're now recognizing is when it then makes a higher high, this is not where the buy trade is in here. That's not where the buy trade is. The buy trade will either be the imbalance area or a spring trade inside that area. So we don't see any strong imbalances. There is a gap between these two candles, so that's technically an imbalance trade area there. And regardless, there was also the blue line, so that would be where your buy trade would be. There is your safest buy trade on the planet right there. How good is that entry price? Can anybody see a widening of the spread at higher prices? Again, for a buy trade. So you can see that we get another widening of a spread here, don't we? We see the spread widening again there. And again, it rejects strongly here. And you can see again that this widening of a spread is created by this little gap again between these two prices. And I would then be, you know that that's there. That's your entry or liquidity. Well, it doesn't make any difference because the price then traded that area there almost immediately. That's your all-in maximum buy trade there and there. And how good are those trades? We went from a buy trade here at 17s. We traded at a high price of 552s. Now that's pretty good. That is a pretty tasty little cheeky outcome, isn't it? Pretty tasty, cheeky little outcome right there. So, when we see how good that is, it's difficult not to see it. And that's the difference, because if this was at the low price, these would never be our buy trades. If this was at the session lows like this one, the buy trade would be here. And in this case, the next buy trade would be here, wouldn't it? But because they're not at the low price, that buy trade moves up into that space. This buy trade moves up into that space. You see that? So, for example, on the basis that this is a bottom edge, well, this is obviously going to be a possible sell trade here, right? You can see that we widened the spread again there. Now, I know it rejected fast, but it still will technically classify it as a widening of a spread, agreed? So when that trade then widens the spread here, there is no imbalance on the spread widening here. When it goes up and it starts widening again to the downside here, you could say, right, well, I've got an imbalance. And if you wanted to sell it, that would be your sell price right there. Well, if you did sell it there, if you were bearish, if you sold it there, that would be your sell trade right there, wouldn't it? Because you know that that imbalance is there. That's where your sell trade is right there. And you're going to hammer that. Now, that didn't on that occasion, it didn't really work out well, but that's because we've already discussed this trade here, right? We've already talked about this trade here. So that didn't work out well at all, but it still made money in a worst case scenario, stop at break even, didn't it? So these tiny little clues, these abilities to get a little bit more aggressive into a widening of a spread area allows us then to recognize the trade. Now, if we can recognize in the background that we're still going lower, take a look at the next widening spread that we could have traded. Well, we go into a higher high here, and we nearly go into a lower low. That's not quite right, but we see what we're seeing. We then definitely get a wider spread here on the upside. We've rejected into the upside, and we've definitely now gone sell side here, haven't we? So on that basis, I'm going to be looking in this area for where the imbalance was. There's the imbalance there. Do you see the imbalance red candle? I know it's a tiny little fella here, but do you see the imbalance there? So that's where your sell's going to be. So when you've got that spread there widening, you're then going to say, right, that's my sell order there. And that's going to be your opportunity to get heavy into a short selling opportunity there, isn't it? How good is that? As a trade setup, is it any good? Well, it has a lot of the qualities of good trades because we've already seen a widening of the spread. So the incentive for the market maker to widen it a second time is probably limited, especially if you're going with the trend. You know, the idea of widening the spread on the upside is all very, very good because you want to see if there's any demand at higher prices. But if they keep selling it and selling it and selling it and then they pull away the bid, this is going to go back towards retesting the low price again, isn't it? So this gives us a very strong story that we're going to be expecting to retest the swing lows as a baseline case. And that gives us a trade that we're going to go 523 to 510s, you know, for a couple of $100 worth of sell side opportunities here. And so when you look at these as potential trade areas and trade outcomes using the highest probability, were they any good as tradable outcomes? Do you think you could actually recognize how nice those trades are? I mean, you know, going from the sell trade here to the sell trade here to the buy trade here to the buy trade here, how many bottom edges have you bought? Well, if you're using the widening idea, you possibly bought in there. Possibly. So there is only two setups. That's it. You know, once you've got the two setups, you can say, right, I've got what I need. My job now is to try and recognize what that means for trading opportunities, for liquidity, for entries. Is it at a lower price? Is it a higher price? Is the value bid? Is the value offered? And it's about working your way through that magical side of the trading where you can see that you don't want to take bottom edges. All you want to do is these types of trades here. And if that was your trading, of course, you've made a lot of money this morning, haven't you? Anyway, welcome, guys. It's just after 1 o'clock. It is Wednesday, the 17th of September. It's, of course, the big day. We finally arrive at the big decision that the Fed has to make. And it's not a big decision in terms of decisions. It's a big decision in terms of narratives. What are they going to say? Hawkish or not quite so hawkish? Dovish or not quite so dovish? This is where the opportunity lies. This is where we see what the trade is expecting to do. And from that, we can start making some plans. The big boys can start making some plans going forward from this information that's about to come out this afternoon. So if we understand that, well, we should be all excited about what we're going to see next. We should see a lot of action. We should see an idea about a big, strong market continuation, which means we go with the trend, whichever way it dices after this comes out, which means we can get into some strong trend trading ideas after this. And maybe they just give us an absolute big dodo. We get absolutely nothing from them. We don't get any insight, and we're left wondering what the hell just happened. So the hope is we get some clarity. Are they definitely now on the move? Are they charging at a faster rate? Or are they not so sure? Where are we going with this? And that's what we're going to be talking about. Today we've been talking about ICE orders, so we'll certainly cover some of that in the classroom. But what happens in London, remember, stays in London. So some of the London guys have made sure that we don't divulge all the stories that we talk about in London. They are, of course, for the Londoners only. And we will certainly cover some of that in the classroom. Let's get through the data that we have seen. And obviously, you might be wondering what the kind of spike was earlier. The spike was some Chinese outputs about NVIDIA chips. Don't buy them. Please don't buy them. They're rubbish. Buy Chinese chips. So obviously that caused a bit of a market move. The equity price came off quite hard, as you would imagine, and the bond price popped a wee bit to the upside at exactly the same time. So fortunately on the bonds we got lucky. Because we were already in a buy trade-off from the belly curve. So we were already long the bonds and we made some nice money on the splash upside. Anyway, let's get through today's overnight sesh one and we'll see where we're at. Okay, so it is, of course, as we said, it is the 17th of September and it is Wednesday. It's a big day for everybody. And we can see if we go through the overnight session, the Japanese numbers came out, exports and imports both declining, but better than expected. You might say better than expected in terms of green. Well, you know, it's remember it's against the green is against the prior numbers. So yes, they are better than prior, but they are worse than expected. You can see that the consensus was, you know, overall they were worse than expected in terms of the import number. 4.2 came in at 5.2. So the trade balance obviously is a little bit offset by one with the other. Trade balance numbers themselves come in at 242.5 against a consensus of 513, but it's still well down on the previous of 118. Moving into the London session, we do get hit with some interesting inflation data, but there wasn't a lot for us, to be honest. But what we did get was bullish bonds. The services CPIs come in at 4.7%. Against the consensus of 4.8 and a prior of 5. So it's a wee bit lower. Again, coming into that narrative, that wee bit lower services year on year is good news. That should be bullish bonds, and therefore buying bonds would make some level of sense, wouldn't it? It would seem reasonable that we should be long treasuries. And that buy on treasuries actually was, as I said, we were lucky on that because we were seeing a flattening of the curve anyway. And we were at a bottom edge. So we're getting curve flattener at a bottom edge. And we already had the services, the UK services CPI numbers available, and the belly fly looked as if we should be able to make some easy money by buying some treasuries. And then we got the Chinese information about Nvidia that popped the price beautifully in our favour. It wasn't a huge one, but it was a good one. That was then further enhanced by the RPI numbers coming in lower as well at 0.4. That's going to be comforting to some degree for the Bank of England. That the two inflation gauges that we've had today have both been less than consensus estimates. The downside for the Bank of England is that the RPI number is just in line with prior. It's not particularly changing any, but it's certainly not rising, and that's good news. Moving past that, we come into the HICP numbers out of Europe. They were also lower than the consensus. Again, still pretty much in line with previous, however. We move past that into the US session, mortgage purchase numbers, mortgage rates, mortgage applications, the 30-year mortgage rate, 6.39%, mortgage applications, a good sizable buy-side pop on that at 29.7. And that's a pretty big number, isn't it? 29.7 against the 9.2 prior. Mortgage market index, a very healthy 386 against a 297 prior as well. And then we move into the US session proper. Housing starts, the big one for the US session. Housing starts numbers coming in at expected 1.3, down from the 1.4. And of course, Bank of Canada at 245 with a rate decision. Past the rate decision, we also have, we also have oil numbers. I don't know where the forecasts are for these. That's interesting. I haven't got the forecasts up. They've been falling asleep at the wheel, these guys, recently. I think they'll be getting told, fix it or we'll find somebody else. And then, of course, we come into the Fed funds target rate. 4.125 against 4.375. You'll notice 25 basis points lower is fully expected. And it is fully expected a little bit further than just the 25. Remember, we do have some lying on the 50 side of this as well. But certainly 100% certain that we're going to get 25 basis points. But as I said, the commentary is the most important. Now, if they do 50, then all bets are off, right? Bonds are going to rip. The equity markets are going to rip. And, and that's going to be a sign of perhaps a bit of a panic move by the Fed. I think it would be a sign of a panic move. So I'm not sure that rip would be long-lived. I think that would be more problematic for the market than a 25 and a dovish or hawkish. So let's see what happens if they come out 25 as expected and they go hawkish. It should go bid on equities to sell. It should go bid on bonds to possibly sell if it's 25 and hawkish. We would then expect to see that they're not as confident about the inflation as we've seen. So I think, that could be the story. But as I said, if that's the big bond story, then it's going to be bullish, then hawkish. So you're going to get a pop to the upside, and then we'll sell it. But if it's 25 and bearish, and if we do get dissenters, Jack, if it's 25 and therefore dovish, and it's a lot more dovish because of the dissenters, then you could obviously imagine that that's going to be really, really bullish for equities and really, really bullish. Really bullish for bonds as well. So let's see what happens anyway. And that's it. That'll be the big one for the day, 1900 hours. So you just don't have to trade it, guys, but you definitely have to know what it contains. You need to read the statement. I know there's probably, I would imagine out of 100 people, there's probably going to be one or two people that actually read the summary points, and most of everybody else just simply watches. So then you're relying on the interpretation of other people, guys. Why not rely on your interpretation for a change? Why not take control of what your interpretation is instead of relying on Fox Business to tell you, oh, it's a good one or it's a bad one? Read it, the summary at least, and see for yourself what you think of it. Or even better still, watch the presser. When there's pressers on for the ECB, Bank of England, Fed, and watch them, see what they say, see what the questions are, see if they struggle with any answers. Think about what they're showing. And that's where we're at, guys. And that'll be us done for that'll certainly be well done for the day at that stage. And that, as I said, will give us a big storyline to work with in the next few days following. Anyway, welcome in, guys. It is, of course, lunchtime, and I am starving. So I'm going to grab some lunch, and I'm going to grab probably 2 lunches because I'm that hungry, and then we'll get started.